Hello everyone, welcome to Taxes 101, helping the people you serve make the most of the tax time. Tax basics for the 2016 tax season. Taxes 101 is a series of trainings in January to assist you with the information, tools, and resources you need to help your clients make the most of the tax time. This is a partnership between the University of Minnesota Extension, Minnesota Community Action Partnership, Prepare and Prosper, Legal Aid, and the Claim It campaign. My name is Taylor Putz, and I work for Prepare and Prosper, and I'm the Claim It campaign manager. The Claim It campaign is a statewide campaign geared at increasing the number of people claiming the Earned Income Tax Credit, as well as utilizing free tax preparation. And Prepare and Prosper is a nonprofit based in St. Paul that provides free tax preparation and financial services. So thank you so much for joining us today. If you have any questions, or if for some reason the sound is not working, please chat us in the chat box, and we will try to answer your question and or fix any of the technology issues that might occur, but cross our fingers that we are good to go. So in the training today, Sarah and I will cover tax basics, tax credits, free tax preparation, and at the end we'll give a very brief 2016 legislative update. So starting off with tax basics. This year, tax day is on April 18th, so mark your personal calendars, mark your professional calendars. Tell everyone that tax day is not April 15th this year, but is Monday, April 18th, 2016. So why is tax time an important time of the year? Here is an important example of a family's monthly income from a book called It's Not Like I'm Poor, where researchers interviewed families in free tax preparation clinics and paid tax preparation clinics. And you can see for this one family that their monthly income from earned income, government benefits, child support, etc., was $2,363. Then when you total their expenses end up to be more than their monthly income. But when the family goes to file taxes, they get a tax refund of about $4,686, making their annual resources now about $33,000. And their annual expenses, $32,000. So the tax refund has allowed them to have a bit more at the end of the year, about $844. And so what could that $844 or an amount larger than that mean for a family? What does a refund mean? Families use their refunds to pay for necessities, things like their monthly bills, repair homes, pay off debt. Remember, a refund is sometimes 40 to 50% of someone's annual income. Maintain vehicles that are needed to commute to work, purchase big ticket items, or start a retirement account, or build a savings. So tax time truly is an important time for a lot of low to moderate income taxpayers. And in the end, it means getting ahead. So if any of the people you work with ask, well, am I required to file a tax return? You can simply show them this chart. So legally, a single person, for example, under the age of 65, making less than $10,300 is not required to file taxes. And the chart continues with married filing jointly, head of household, etc. So we generally tell people that they should file taxes, especially people who have had any income tax withheld from their pay. Most likely this will result in a refund. And Sarah will talk a little bit about how a refund is developed through tax credits. Additionally, if someone qualifies for the Earned Income Tax Credit or the state's version of the Earned Income Tax Credit, the Working Family Credit, if they qualify for the Additional Child Credit, if they receive their health insurance through MNsure, they could be eligible for the Premium Tax Credit. Additionally, if they're in post-secondary education or they're a parent of a K-12 education student, they could receive the American Opportunity Credit or other tax credits. Additionally, if someone owns a home or rents an apartment, they could receive a refund come tax time. So if you don't know anything about any of these tax credits, that's okay. That's something that Sarah will be covering in the rest of the presentation. So just hold this information tight as we continue throughout the presentation. So now I will hand it over to Sarah.
Hi, everyone. So Taylor talked a little bit about who needs to file tax returns. The chart in the beginning applies to people who are wage earners or have other sources of income. There's some special rules for people who are self-employed or people who are claimed as dependents on another person's tax return. So the general rule applies. The chart that Taylor showed kind of applies to most people. But if someone's self-employed, if you have a client who is self-employed, their filing requirement is much lower. If you have net self-employment earnings of greater than $400 a year, you need to file a tax return. You're required to file a tax return. So that amount is really low. Pretty much anyone who makes their living as a self-employed person will need to file a tax return. Taxpayers who are claimed as dependents on another person's tax return may also need to file their own tax return. This really comes up when you have working teenagers, is one of the main places that this comes up. So you have parents who claim, their 15, 16, 17-year-olds. Those 15, 16, 17-year-olds have jobs of their own. They need to file a tax return in certain circumstances. The rules on when a dependent and how a dependent must file can be complicated. What I typically recommend, if you have a situation where there will be multiple tax returns filed in your household, that everyone go to the tax preparer together. It helps everyone understand how all of these pieces fit together, and it also helps preparers get the best tax outcome for the family as a whole. So when you file your tax return, you are going to claim your taxable income on the tax return. So taxpayers often have both taxable and non-taxable income. Some examples of taxable income that have to be reported on a tax return are wages, non-employee compensation, so that's things that come on a 1099. Self-employed people often have non-employee compensation, unemployment compensation, retirement plan distributions, and cancellation of debt income. We're going to go through some of these in a bit more detail further on in the slides. And some examples of non-taxable income, so income that does not get counted when we're deciding when people need to file and what needs to go onto a tax return. Examples of that are public benefits, so most Social Security payments, gifts, and inheritances. Social Security can be taxable, but only if a person has enough other income to push them into the taxable Social Security. In general, if somebody's only income is Social Security, it's not going to be something that's taxable and reported on a tax return. So one of the areas that can cause a lot of problems for taxpayers is non-employee compensation. These are taxpayers who work typically on a per-job basis and are paid sort of a lump sum per job they do. They receive a 1099 miscellaneous at the end of the year, and typically it means that no taxes have been withheld from the income, so that the person paying them hasn't paid anything over to the IRS. If the taxpayer receives a 1099 miscellaneous from their employer, which would actually just be the person paying them, it means that they're an independent contractor and they haven't had taxes withheld. Independent contractors are considered self-employed and they're responsible for paying all of their own income, Social Security, and Medicare taxes. So just the Social Security and Medicare taxes portion of that can amount to about 15% of their of what they earned. So this can create a problem because taxpayers aren't aware that they're going to owe that. You could have a very, low earning taxpayer who's really just making enough to kind of get by, but they're going to owe taxes at the end of the year. So it's a good thing to talk about with people. So just to kind of give you an example, if somebody has 1099 miscellaneous income of $10,000, it could at the end of the year amount to at least, roughly a $1,500 tax liability for the self-employment portion of the tax, whereas they wouldn't owe any income tax, but they would still owe the self-employment. So taxpayers do need to be aware of that if they're not a wage-earning employee. Unemployment compensation is taxable. From what I understand, it appears that the default position when you get unemployment is to not withhold tax, that you have to ask specifically if you want tax withheld from your unemployment. If you don't have the tax withheld, at the end of the year, you may end up owing some taxes on your unemployment compensation. This would especially be true if somebody was employed for, the majority of the year, let's say 8 months, and then had 4 months of unemployment compensation. They're probably high enough that they're going to have taxable income, and if that unemployment doesn't have tax taken out, it may cause them a tax liability at the end of the year. So we talked a little bit about income, and Taylor talked a little bit about refunds. So we're going to try and go into a little more detail about how do these refunds happen, how do people make the most of tax time. So there's a couple of different things that you're going to claim on a tax return. You're going to claim tax deductions, and you're going to claim tax credits. A tax deduction reduces the amount of income a taxpayer pays tax on. So the taxpayer has a lower taxable income. So if my income is $10,000 and I qualify for a tax deduction of $2,000, my income tax would be based on $8,000, not $10,000. A tax credit, on the other hand, reduces the amount of tax you pay dollar for dollar. So let's say I do my tax return, I get to the end, and there's a line on the tax return that says tax owed or tax. Let's say that says $6,000, but I qualify for a $4,000 credit. I will end up paying $2,000 of tax. So that credit will reduce the tax I owe dollar for dollar. Tax credits can be refundable or non-refundable. We'll talk about that a little bit more in a minute, but basically a refundable credit is treated like a payment that the taxpayer made. So they could actually get a bigger refund based on that credit because it's treated as if they made a payment rather than just a credit against the tax that they owe. A non-refundable credit is just treated as a credit against the tax they owe. If they owe $1,000 of tax and they have a $2,000 credit, if the credit is non-refundable, $1,000 of that credit will go to reduce the tax, and the remaining $1,000 of that credit just sort of goes away. They don't get it back in a refund. It doesn't matter. So we're going to go through all these credits, and people are going to say, I had no idea that I could qualify for these credits. I filed my tax return last year and I didn't claim any of these, and I think that I might be entitled to them. Taxpayers can go back and amend their tax return for the 3 previous tax years. And there's just one mistake on this slide that should say tax year 2012. So taxpayers this year, if they file before April 18th, can amend their tax returns all the way back to tax year 2012. So if a taxpayer figures out they were entitled to a credit, what they're going to want to do is go back and amend their tax returns. They can amend 2012, 13, and 14, as long as they do 2012 before April 18th. The next thing that we're going to talk about before we get into the details of the credits is revenue recapture, because this is sometimes a disappointing time for taxpayers. They complete their tax return, they get really excited that they're going to get this refund, and Minnesota keeps the refund that they were very excited to get, and this applies to your state refund. So let's say I finish my state return and I find out I'm going to get a $2,000 refund. But instead of getting that refund, I get a letter in the mail saying that my refund was sent to an agency that I owe money to. The agencies are typically state agencies, state courts, counties, cities. The sort of one that surprises people is that it can also go to some hospitals. So if somebody has an outstanding hospital bill, there's state refund may be used to pay off that bill. There are some instances where, especially hospitals, it's primarily hospitals and other medical billing, cannot use the recapture system. So a taxpayer may want to seek some guidance on whether or not their refund can be taken if it was taken by a hospital or other medical facility. There is some resources on the Minnesota Revenue webpage. If you enter revenue recapture, a fact sheet should come up in the list of resources that gives some information about how revenue recapture works and what to do if a taxpayer doesn't agree that they either owe the debt or that the person using revenue recapture can use it. When we file a tax return, taxpayers are going to use either a Social Security number to identify themselves on the tax return, or if they aren't eligible to obtain a Social Security number, they're going to use an individual taxpayer identification number, or ITIN for short. Everyone who lives in or earns money in the United States is subject to the tax laws of the United States and has to file a tax return. So some people think, I don't have a Social Security number, I'm working off of the books, I don't need to file a tax return. That's not true. If you are earning money in the U.S., you need to be filing a tax return, whether or not you have a valid Social Security number or you're using an ITIN to file the return. Everybody needs to be filing a return. So under the table income is still income and it still needs to be claimed on a tax return. Taxpayers who are eligible to work in the United States typically have Social Security numbers. If somebody is not eligible to work in the United States, they may be working under a Social Security number that doesn't belong to them. That does not mean they can't file a tax return. It means they need to get an ITIN number and they need to have that income associated with their ITIN number. And there is a way to do that, and there are wonderful people around who will help taxpayers get these ITIN numbers and file their tax returns correctly. All right, so we're going to talk a little bit about tax credits. All right, so as we talked about earlier, I'm going to just breeze by this. There are two types of credit, the refundable credit and the non-refundable credit. The refundable credit are the ones that can really make a huge difference in the income of our clients. And these are treated as payments. So if I have a $3,000 refundable credit, and my line on my tax return says I owe $2,000 of tax, $2,000 of that credit will reduce my tax to zero, and that remaining $1,000 will get added to my refund. So it's like I made a payment of $3,000, and they're going to refund the extra money. So that makes my refund bigger. And just a little note on another really great resource is the tax credit guide. So if you want to know more about these credits, this will give you more detailed information, and it's really great to have to pass out to your clients and to anyone else who might have questions about all of the different tax credits that are out there. All right, so the first tax credit we're going to talk about is the Earned Income Tax Credit. This is the largest of the refundable credits. It is available to people with and without children, which is kind of important to recognize, since the credit for families with children is larger, but there is still a credit for families without children. So everybody should really be thinking about this at tax time. The maximum credit this year is $6,242, and that's for a household with 3 or more qualifying children. So the credit can be quite large. You have to have earned income to claim this credit. You have to have a Social Security number. Your spouse has to have a Social Security number. And the children that you're claiming on the tax return have to have Social Security numbers if you're claiming them as qualifying children for the Earned Income Tax Credit. If you don't have qualifying children, there's an age limit for the Earned Income Tax Credit. The taxpayer must be between the ages of 25 and 65. The taxpayer claiming the Earned Income Tax Credit has to be a United States citizen or resident alien for the entire year. So people who, come to the U.S. in the middle of the year, that first year that they arrive will not be eligible for the Earned Income Tax Credit, but they should be thinking about it for the following year. The other rule is if you're claiming the Earned Income Tax Credit, you cannot be somebody else's qualifying child for the Earned Income Tax Credit. So if somebody else can claim you for the Earned Income Tax Credit, you cannot claim somebody else. So this might be a case if you have parents claiming their own children who might be claiming their own children. If you have a younger parent, a teenaged parent, you can't do it that way. Or if a parent can claim, there's lots of ways it could happen, but in general, if somebody can claim you for the Earned Income Tax Credit, you cannot claim your own Earned Income Tax Credit on your tax return. Here's a table to give an idea of the income limits for the Earned Income Tax Credit. So it actually goes up pretty high. The credit follows a bell shape, so it starts low, it kind of peaks in the middle of this range, and then goes back down as your income gets higher. But everyone should be thinking about it, but here's a chart that shows you who qualifies, the maximum income to qualify for the Earned Income Tax Credit. There's a corresponding state credit. It's called the Working Family Credit. If you qualify for the Earned Income Tax Credit, you'll qualify for the state Working Family Credit. The maximum for this credit is $2,038. This one maxes out with 2 children rather than 3. So, if a family has 3 children, it's all going to be the same after 2. The next credit that we're going to talk about is the child tax credit. This is a tax credit for working families that have a child that is age 16 or younger at the end of the year. The maximum credit is $1,000 for each dependent child that's claimed. And to be eligible, you have to have federal income in an amount greater than 0, claim a qualifying dependent child age 16 or younger, and you can claim this one with a Social Security number or an ITIN. So this is available to everybody who's filing. So everybody should be thinking about the child tax credit. The next one we have is the Child and Dependent Care Credit. This is for families who are paying for child care while the parents are either working or looking for work. That's kind of the key here, is that it's only for care that's provided during working hours or during hours that parents are looking for work. The maximum federal credit is $1,050 if you have expenses for 1 dependent and $2,100 for 2 or more dependents. There's a state credit that follows the federal credit, and the maximum amount for the state is $720 for 1 and $1,440 for 2 or more. To be eligible for this credit, you have to have earned income in 2015, and you have to have paid for your dependent child, care for your dependent child who's under age 13, or an adult or older than age 13 but unable to care for him or herself. And that person needs to have lived with you for more than half of the year. For Minnesota, the household income needs to be less than $39,000. You can claim it with a Social Security number or an ITIN. The next credit we're going to talk about has to do with education. It's called the American Opportunity Credit. And this is for students who are pursuing a college education. It's available for students during the first 4 years of their college education. So it's available for the first 4 years only. It's $2,500 for each eligible student. It can be claimed by the student, or if the student is claimed as a dependent by their parents would claim the credit. Some of this credit is refundable, meaning that it makes the taxpayer's refund larger. $1,000 of this credit can be refundable. It's based on the qualifying expenses of the student. Some examples of qualifying expenses are tuition, enrollment fees, and required course materials. To be eligible, the student needs to be pursuing a degree or recognized educational credential. They need to be enrolled at least half-time for one academic period. They can't have completed their first 4 years of post-secondary education, and they can't have been convicted of a felony drug offense, and they can't have claimed the American Opportunity Credit or Hope Credit more than 4 times. Kind of the most important part of this is the enrolled at least half-time. That's based on the institution and what the institution considers to be more than half-time. A student really wants to make sure that they meet that requirement before they claim this credit. The next education credit that we're going to talk about is the lifetime learning credit. This one, the eligibility requirements are much more broad. The maximum credit is 20% of qualifying education expenses up to a maximum credit of $2,000. This one, none of it is a refundable credit, but it's available to anyone attending any eligible educational institution to acquire or improve job skills. The student doesn't need to be pursuing a degree program. There's no requirement on full-time, part-time, anything like that. So this one is really broad and can apply to a lot of people pursuing, education, even if they're only taking a credit or 2 a semester. So people are really going to want to be thinking about whether or not they've taken classes that are intended to help them either further their current position or get a new job. These are things to be thinking about. So the state also has an education credit, but it's geared at K-12 education. So this is a credit for parents who are paying qualifying educational expenses for their children in grades kindergarten through 12. The credit can be up to 75% of expenses, and you're going to use things like paper, pens. So this is basically school supplies. So all of the school supplies that you're purchasing at the beginning of the year, if you're purchasing or renting musical instruments, transportation fees for school field trips, after-school education programs, tutoring. Kind of a big one is some summer camps will qualify for an expense for the credit. You can also use computer expenses up to a certain amount for the credit. So parents should be reminded at the beginning of the year to be saving receipts so that they can claim this credit if they're eligible. Some of this credit is refundable by the state, and here's a little bit about the eligibility. You have to have a qualifying child in the grades K through 12. The income limit on the credit portion of this is $37,500 for families with 1 to 2 children. That increases by $2,000 with each additional child. The maximum credit is $1,000. You need to save all of your receipts so that you can record this, and if you get audited, you'll have proof that you had the expenses. One more thing on the education credit, there's also an education subtraction, and that's for families that, either their expenses are greater than what's accounted for by the credit, or their income is too high to qualify for the credit. They could still qualify for the subtraction, which works like a deduction. It reduces their taxable income, so pretty much all families should be saving all of the receipts for educational expenses, educational camps, instruments, everything like that, and bring them when they get their taxes prepared. The next credit we're going to talk about isn't talked about very often, but it's the retirement savings credit. And this is a really important tax planning tool for families. And especially, I think it really comes into play for younger, single, or married adults who may have a little bit of tax liability. And they can eliminate that tax liability by putting money into a retirement savings plan. So the maximum credit amount is 50% of contributions. It depends on your income whether you're going to get 50%, 20%, or 10%. And it needs to go into, a retirement vehicle. It can be up to $2,000 or $4,000 for a married filing jointly couple. You need to be 18 or older. You can't be a full-time student, and you can't be claimed as a dependent on another person's return. This can eliminate the tax that some people owe and help them start saving. So it's something to think about, talking to taxpayers about, especially if, they owed a tax last year and they know they're going to owe tax again. They may be able to get some of that back. And when we talk about owing tax, the other thing we want to think about is taxpayers might not actually be paying in at the end of the year because they've had enough withheld that they don't have to pay. But if they look at that tax line on their tax return, they're still paying tax. Some of the money that they had withheld is going to the government as a tax. They may be able to reduce that by using this retirement savings credit. So it's something to think about with taxpayers and to mention that it's out there. Next credit we're going to talk about is sort of a new one. It's called the premium tax credit. This is associated with the new healthcare law. This is really important. It's for people who receive their health insurance through MNsure. It's not for people who get health insurance through their employer or through a government program. It's people who buy it through MNsure. So if you have taxpayers who did buy health insurance through MNsure, they're going to want to file a tax return to see if they're eligible for the premium tax credit. Most taxpayers who are purchasing insurance through MNsure are already aware of whether or not they qualify for the premium tax credit, because most taxpayers who are purchasing insurance through MNsure are having some of their premium tax credit distributed throughout the year. And what happens is that premium tax credit is used to offset the premiums that they're paying each month. If this is the situation, this is a must-file situation. A taxpayer who is receiving premium tax credit throughout the year to reduce the amount of money that they're paying for premiums has to file a tax return at the end of the year and needs to reconcile the tax credit that they got throughout the year on their tax return. It's very important that people are doing this. It can cause future problems if they've gotten the premium tax credit in the past and have not filed a tax return for that year to reconcile the amount. So really talking to people about how they're getting their health insurance and whether or not they are claiming the premium tax credit is pretty important. So there's some information about the maximum credit and the eligibility. But like I said, most people who are entitled to the premium tax credit are somewhat aware of it and probably getting it throughout the year as an offset to their premium payments. The thing that I think is important also to recognize about this is if somebody's receiving the premium tax credit throughout the year to reduce the amount of their premiums, they want to make sure that they're really in close contact with MNsure and updating all of their income information throughout the year or other changes in family status, because these can change the amount of premium tax credit they're entitled to. So if they, had a huge bump in income halfway through the year and they don't report it, they might be getting too much premium tax credit, and at the end of the year they're going to have to pay some of that back. So people need to be really aware of what their income is and make sure that they're reporting any changes. The next refund we're going to talk about is the renter's property refund. This is for people who rent and live in Minnesota. They may be eligible for a renter's refund. It will be based on income and the amount of rent you're paying. A taxpayer should be getting a certificate of rent paid from their landlord. They need to file the credit, or they need to file the claim for refund by August 15th. You can claim up to 1 year late. So for this year, that means the refund, the final chance to claim the 2015 refund would be August 15th, 2017. So taxpayers want to think about that. They also want to think about that if they might have been entitled to the renter's refund for last year, they need to claim that by August 15th, 2016. You know, it's a great credit. It's available to people who may not have to file a tax return, so it deserves extra mention with your taxpayers. Even if you're not filing a tax return, you know, an income tax return, you want to think about this renter's property refund return, because it can bring in over $2,000 for a family if they are renters. To be eligible, you can't be a dependent of somebody else. You have to have lived in a rental unit in 2015, which is assessed property taxes. These are most rental units. There are some exceptions, but most people are, you know, renting a unit, and the owner is paying property taxes. You have to have been a full or part-year resident of Minnesota in 2015, and you have to have a household income for the renter's portion of this refund of less than $58,490. There's a similar credit, and this is for people who own a home. It's called the Homestead Credit Refund. This is for people who own a home and are paying property taxes. You may be entitled to get a portion of your property taxes refunded to you. And this is the taxes that you paid in tax year 2015. The due date is the same. So again, you have 2 years to claim it. You could claim it this year, or you could claim it next year. So the 2015 refund claim is due by August 15th, 2017. That is your final day to claim it. But we recommend that people claim it in the year that, you know, it technically should be claimed in, which would be this year. So this year, the maximum property tax refund for homeowners is $2,640. This can be a huge help for homeowners, especially homeowners who might have trouble paying their property taxes. They can then use some of their property tax refund to pay the future property taxes. The rules for this is you can't be a dependent, same thing, full or part-time resident. You have to have paid all of your property taxes, so you need to be current on your property taxes to claim this. You have to have a household income of less than $107,930. You have to have a homestead classification approved for your home. So that means, you know, you have to be living there. You can't be renting it out and claim this credit. You have to have owned or lived in your home on January 2nd of 2016. And I'm going to turn it back over to Taylor to talk about free tax preparation.
Awesome. Thank you, Sarah. So we always like to say the best way to claim all of these credits is by filing your taxes for free, so you don't pay hundreds of dollars for paid tax preparation. So I'm going to talk a little bit about what free tax preparation is and how you can find the closest free tax preparation site near you. So what is free tax preparation? There are over 290 free tax preparation sites throughout the state of Minnesota. So there could be one in your community. Who is actually preparing the taxes? The taxes are prepared by IRS certified volunteers. These are volunteers who have gone through 20 to 40 hours of training and passed a test before they actually start preparing taxes. And these are volunteers, which means they're passionate, and they will help taxpayers get their maximum refund. Every return at a free tax preparation site is prepared and then reviewed by a second set of eyes to check for accuracy. And at free tax preparation sites, free really means free. There are no hidden fees at free tax preparation sites. A lot of taxpayers think there's gimmicks when you put the word free in front of tax preparation. So you can assure them that free really does mean free. Additionally, e-file is available. And so when you e-file and it's used with direct deposit, taxpayers can get their refund quickly. Sometimes taxpayers choose paid tax preparation because they promote getting their refund quickly. And at free tax preparation sites, we can also get them their refund as soon as possible. So there's different types of free tax preparation sites throughout the state. Two important ones are the VITA sites and TCE sites. VITA sites are volunteer income tax assistance, and those are income-based, usually around $35,000 for an individual and a family making under $55,000. There is no age requirement for VITA sites. TCE sites, or tax counseling for the elderly, are managed by AARP, and interestingly enough, there is no age requirement to file your taxes at AARP, nor is there an income requirement. However, if you made $500,000 in 2015, you should be able to pay to file your taxes. Additionally, there are several law clinics in Minnesota. Those are for complicated situations only, and tax preparation does not happen at law clinics, but they're for after the fact. So this is a map of Minnesota. On the left are where all of the VITA sites are by county, and on the right are where all of the TCE sites are, the AARP sites throughout Minnesota. So there's almost one pre-tax preparation site in every county. So where can you find the site closest to you? Go to www.youclaimit.org. Click on the tab that says File Your Taxes for Free. It'll bring you to a page that looks like this. Click on the button that says Find a free tax preparation site nearest you, and it'll bring you to the Minnesota Department of Revenue site where you can type in your zip code and find the closest free tax prep site. This site, I don't believe, is live right now on the Minnesota Department of Revenue website. As a general rule of thumb, all free tax preparation sites open the first week of February, and so they'll be releasing the full list for tax season 2016, hopefully in the next few days. So check back to the site often. Another option for taxpayers is MyFree Taxes. So if someone wants to file their taxes online, MyFreeTaxes.com is an awesome resource. It's free, and it's for taxpayers who have made under $62,000 and have fairly simple returns, so they feel comfortable filing their taxes online. There's a 98% conversion rate after disqualification, so this means 98% of the people who started to file their taxes with MyFree Taxes continued it. This is great for simple returns and returns that are out of scope. So if the closest tax site near you is a VITA site, so it's income-based, and you made, as an individual, maybe $55,000, you can still file your taxes for free using MyFree Taxes. And MyFree Taxes, you can begin using it today. And actually, the IRS, I believe, started accepting returns yesterday. So if you have all of your documents, you can file your taxes today. The great thing is there's free chat and a helpline with MyFree Taxes. The important thing here is you can file your federal and state for free, and then when you go through to fill out the form to create or to fill out your property tax return, you actually have to print out the property return and mail it to the Department of Revenue in order to receive your renters or homestead rebate. Then lastly, we want to just provide a brief legislative update for things that are happening in the state legislature that affect tax credits for working families as well as funding for free tax preparation. So first, the Minnesota Asset Building Coalition is a statewide coalition, and they're leading an initiative to get the Tax Time Savings Grant Program bill passed. This would essentially increase funding for free tax preparation services. Last year, the amount of funding that was available only was able to fund half of the requests. So they want to increase the funding for free tax preparation services, hopefully allowing there to be maybe more than 300 free tax preparation sites in Minnesota. Additionally, they want to create a new source of funding to make financial capability services available at free tax preparation sites. So these are things like opening a savings account, pulling a credit report, maybe opening a retirement fund. Because tax time is often a money moment, free tax preparation sites and organizations are looking to maximize on tax time for the people that they serve. Additionally, there's an initiative being led by the Minnesota Budget Project, which is an initiative of the Minnesota Council of Nonprofits to increase the working family credit. Remember, this is the state version of the earned income tax credit. They want to increase the size of the working family credit that current recipients can receive, also increase the income so more people can receive this tax credit, and also increase the ages of the eligibility so more people can receive this tax credit. So if you'd like more information on any of these two legislative initiatives, please contact the respective organizations, the Minnesota Budget Project or the Minnesota Asset Building Coalition. Lastly, there is another webinar coming up tomorrow, same time, resources for parents, divorced parents, and never married adults claiming children. It's a webinar, and you can register at the link on the screen. So with that, I believe we have 10 minutes left. If anyone has any questions, please feel free to unmute yourself and ask a question of either Sarah Bronson or myself. And our contact information is on the screen, so feel free to follow up with us after. You can also chat your question in the chat box, and we will remain on the line.
Can you hear me?
Yes.
Okay, I have a question. Can we download and save this webinar?
Yeah, so the webinar will be posted, the recorded webinar will be posted on helpmnsave.org, as well as University of Minnesota Extension website. And then you should have received the slides and other handbook via email, but I will also send those out again as well. So you watch for those in your email, as well as watch for an update on when the link is posted on helpmnsave.org as well.
So someone asked us a question in the chat box, and I'll let Sarah answer this one. But the question is, does the K-12 education credit apply to those special education students who don't formally graduate until the age of 22? Great question.
It is a great question, and one that I would have to look up to be sure, but I think as long as they're still considered to be in a K-12 education program, it would still apply. I know there are some transition programs that happen. They're not technically considered 12th grade. They happen after that. So I think it sort of depends on what the education is that your student's receiving.
We have another question. What about taxpayers who worked half of the year in Canada and half of the year in the United States? And I'll let Sarah answer that question.
So I'm not exactly sure what the question is about. Taxpayers will have to claim all of their income, especially if they're a resident of the U.S. There are some different rules that apply to foreign income, and you can, take some credit for foreign tax paid, but that's a situation where I think that a taxpayer really needs to consult a professional tax preparer to help them sort out how they claim that income and also how they claim any taxes they may have paid to Canada on their Canadian income. But in general, if you're a U.S. resident, you need to claim income that you earned anywhere, but there is help for you if you're also paying tax in another country.
I have a question. I was wondering, we hear often about the free taxes for federal. Is there anything for people to file Minnesota?
Yeah, actually, on MyFreeTaxes.com, you can go ahead and file up to, I believe, 3 state returns using MyFree Taxes. And at free tax preparation sites, they will help you file your federal, state, and property tax returns.
Okay.
Awesome. Good question. And then we have another question from the chat box from Chelsea. Does the premium tax credit apply to an individual in a household who enrolled in health coverage through MNsure, but their spouse is enrolled in Medicare?
Yes. For the person, as far as I know, for the person who did apply for health insurance and is paying for health insurance through MNsure, they would qualify for premium tax credit. Their spouse, who if they're enrolled in Medicare, would not get the premium tax credit for that portion. So I have a question. What about taxpayers who worked in 3 states in 2015? If there are taxpayers who worked in several states in 2015, they may have to pay tax for all of those states. Again, that's kind of a complicated issue where a taxpayer is going to want to seek help of a tax preparer, likely a CPA in that situation, because there's rules about what needs to be claimed in Minnesota and what needs to be claimed other places. And again, there are offsets for taxes paid to other jurisdictions, so other states. But everything really needs to be accounted for. So taxpayers in that situation do have a more complicated tax return and probably one that needs professional assistance.
Another question, does the rental refund apply to individuals who pay subsidized rent?
Yes. So if an individual is paying rent, the rental refund applies to them. Their landlord should be issuing them a certificate of rent paid. That only includes the amount of rent that the taxpayer is paying. So if they're in a situation where they're paying, 30% of their income has to go to rent, and then the county or state is picking up the remainder, the taxpayer should get a certificate of rent paid, showing only the amount of rent that taxpayer actually paid, and they would use that to claim their renter's refund.
So with about a minute left, does anyone have a final question? If you'd like to follow up with myself or Sarah, feel free to reach us by email or by phone number. Does anyone have a final question? Hearing and seeing none. Thank you so much for participating in this webinar today. You'll receive an evaluation at the end. We look forward to your thoughts. Thank you so much to the University of Minnesota Extension for hosting this webinar, and have a great tax season, everyone.
Thank you. Bye.